He's famous for having done this to me on a radio show once. This is 20 years ago. We're on this radio show. I used to do a radio show in Lake County for a year or two, and I brought him on, and some guy asked a question. I don't even remember what the question was.
Uh-huh.
It said, thought about it. I have no comment on that.
Yeah.
And I looked at him. I'm like, you're not allowed to not have a comment. The guy called it.
Yeah. Okay, that's a wrap.
Yeah. Well, this isn't the courtroom. You're not pleading the fifth.
Yeah. Did he have a Paul Harvey voice?
He did.
And now the rest
pretty
of the
much,
story.
Yeah. Welcome to ScottCast, the podcast 26. You're telling me, Vin? Yeah, 26. ScottCast, the podcast 26, and we have a very special guest today.
Where?
Yeah. Well, he's coming. It's not you. I promise you.
Yeah.
John Eicher is here with us today, and one of the reasons I'd like to talk to Vin, but he's over there now. Like I talk here, I'll talk there. One of the reasons, Vin, that we have John on the show today is it's tax time will soon be upon us. April's when most people get pretty neurotic about their taxes, and John is very well qualified. Not only is he a CPA, but he was also the CFO for a pretty well-known company here in Central Florida. I think it's okay to say that you were the CFO of ABC Liquor for a very long time.
Yep, I was.
Yeah. It didn't result in me in getting any free bourbon or anything, but that's another discussion.
No.
But needless to say, John is very well versed in many things tax-oriented. And so what I thought we'd do today, John, was we would talk basically about April coming up, some of the things you see sometimes in talking to friends and clients and whoever, mistakes people make, things they overlook, maybe some ideas that have come up recently, laws that maybe have changed that you're familiar with. And I will put the disclaimer in now for the compliance department that's going to be pulling their hair out over this. We are not suggesting you do any of these things
Right.
that may or may not be good ideas without consulting with your own tax preparer first. Is that a fair?
Absolutely.
Yeah. So with that said, no, I'm just kidding. Let's start off by talking about, I don't know how many people actually itemize. So one of the things people are confused by, if I itemize, do I need to itemize? Because the current standard deduction's pretty big,
sporty now, yeah.
Pretty sporty, a good way to put it. So
it went up, but it's over $24,000 for a married filing.
So
joint, yeah.
Is it fair to say that unless you're going to come away with $25,000 or more, or whatever the number is, in itemized deductions, you're kind of spinning your wheels?
Right. And I think that was the purpose of the law. They wanted to get rid of a lot of, needless bookkeeping. People would come in with all their little receipts and, nickel and dimes.
Their shoebox.
Yeah, their shoebox.
Yeah.
And this gets rid of it. I still do tax returns. I volunteer for tax aid. And the first year, we still had the lower itemized, and people would bring in a lot of stuff, and we did a lot. It's Schedule A itemized deductions. We did a lot of that, but since
now, what is Schedule A?
That's where you do. When you itemize.
Yeah, that's what the actual form is called.
It's on Schedule A.
You'd think I'd know that, but I don't know what that is.
Do you
I have an accountant.
Yeah. Do you look at your tax return?
Yeah. I don't know. Sign here. Okay.
Yeah. So anyhow, I think that was one of the purposes of that law that Trump signed, was that it got rid of.
Okay.
It really kind of rendered Schedule A kind of a useless form, because it's such a high hurdle now to get past it.
Right.
That most people can't.
Yeah.
So it just takes care of a lot of record keeping for people. They just they said, here's a huge deduction. Let's move on.
So what percentage, just if you had to guess, would you say of the population that applies to, where it's like, look, you're wasting your time filling out this Schedule A?
Last year, I think I only had one person who actually itemized. And she was one of these folks that was, she tithed with her church.
Gotcha.
So she gave like $30,000 to her church or something like that.
So, all right, well, that's a great taking off point. What percentage of your income do you have to give to charity, or does it matter before you start to get that deduction? Does it matter?
Well, that's one of the things that changed this year. They did change the law. First of all, let me back up a little bit. There's a lot of law changes this year.
Yeah.
So there was three separate acts. All these PPP acts that the president signed.
Yeah.
Well, there's a lot of tax law change in all those acts too. So whatever tax repair you're going, make sure that they're well versed. There's a. I just finished my study for because I have to recertify every year to prepare tax returns, even though I'm doing it pro bono.
Sure.
And but it was a very difficult year because there was so much new in the tax law this year.
So correct me if I'm wrong. What you're trying to say is that legislatures slip things onto bills.
I know.
I know.
I was shocked.
Yeah,
I was shocked.
Stunning.
And I'm glad we're sitting down for this discussion.
Woo. Oh.
But anyhow, there are a lot
knock
of
me
changes.
over with a feather, Vin.
Yeah.
All right. So I would say in my client book, probably has a disproportionate number of people that do need to itemize, and do have, maybe they're entrepreneurs, they have businesses, or they own a law firm or a plumbing company or whatever. Is there one or two mistakes or things that you see repeatedly for people who do itemize where they're missing the boat at all?
No.
Yeah.
But the thing, there is a strategy. It's perfectly legal. It's not like any wild idea. But there's a lot of people who are able to almost itemize, but not quite. But if you do some planning ahead of time, what you can do, it's a technique called leapfrogging. But what you can do is you can actually double up deductions in 1 year. So instead of paying your real estate taxes this year, wait until the 1st of January, pay it in January, then that following December pay, you get a big doubling up.
Yeah.
And same with charitable contributions. Instead of writing a couple $1,000s worth of charitable checks in December, write them in January.
So
you double up in 1 year. So you're always going to get at least that $24,000 deduction, standard deduction.
Yeah.
But in the off years, you may be able to get a $30,000 deduction.
So to clarify.
So that's not a mistake.
Yeah.
But it's a strategy that I see people fail to take advantage of.
Because you've explained this one to me before, and it was a mind blower for me when I thought about it, which it's easy to blow my mind. Don't laugh, Finn. So what was the other thing you said? Not just property taxes, but
property taxes, you can double up on charitable contributions.
Charitable contributions,
Yep.
Okay.
Anything that you have control on when it gets paid.
Mm-hmm.
You look at you look at the things that are typically on Schedule A.
Yeah.
And even mortgage payments, you could you can make a mortgage payment early or late in the year, and then that way the interest for that payment only will go to that year. So.
Okay.
So whatever you can control. I mean, some things you can't control, like sales taxes you're going to pay when you have to pay them, medical expenses. When you need medical attention, you're going to get medical attention.
Now, is that 7% over your adjusted gross income
so
before you can deduct?
Yeah,
right?
So it's a high hurdle,
and
not many people take advantage of it.
So if you make $100,000, you have to spend over $7,000
just to get on Schedule A.
Just to get on the schedule.
Then everything on Schedule A has to exceed that $24,000.
So you still got an immense hurdle.
Yeah, and it's, you and I aren't going to get it, but your mother or somebody it's in a nursing home, they'll get it.
Yeah.
But the problem for that, though, is that because they're in a nursing home, they're not working.
So their income isn't high.
So the deduction isn't really that great because there's not really much income against. So that's a catch-22.
Yeah. Again, it's shocking. So the RMD this year, the required minimum distribution.
Right.
Last year for 2020, it was waived. You did not have to take that. So the reason that's important for people to understand is because if you had $100,000 in an IRA and you had $100,000 in a non-IRA, non-qualified account,
right,
but you were over the age of 70 and a half, now it's 72,
right,
you were required to take a certain amount out and pay taxes, right? The government wants their piece of the action.
Right, but they waived that in 2020.
They waived that in 2020, so you didn't have to take that out and pay taxes. You could take that. If you needed income, you could take it from somewhere where either you paid capital gains rates or zero, depending on what the vehicle was. But looking at 2021, my guess, and maybe you'll correct me, is that they're going to do it again. That's my guess.
Well,
how do you feel about that?
I hope your guess is right.
Yeah.
Yeah.
You don't have any intuition on that?
No, I don't have any intuition on that. I'm trying to recall. I don't remember in my readings on that there was any thought of doing that again in 2021.
Okay.
But
so you're saying I'm wrong?
I'm saying you could be right.
I like how he did that. Yeah. For an accountant, he's pretty slick.
But the jury's still out on that is what's going on.
Yeah.
I mean,
I could be right.
It could be right because,
I want to be right.
There's a whole new judge in.
Yeah,
there's a whole new sheriff in town.
There's a new sheriff in town.
There's a new sheriff
put.
in town, so who knows what's going to happen.
Right. And I'm sure the people on the other side of this camera have a lot of opinions on that, and I don't want to hear them. But anyway.
There's a whole new sheriff in there. And, Eddie Murphy said, I've got a dragon and I'm not afraid to use him.
That's right. That's right. Yes, he did say that.
Yeah.
So, all right. So what, in going into tax planning for April, when people are preparing, and again, we're going to assume these are people that have higher incomes, what are a couple of key things you see people underutilizing? Do people typically max out their IRAs, do you find, when you're doing returns, or people leaving some tax deduction on the table? Or 401k, whatever it is?
Well, now there's not really a whole lot you can do for 2020 because
you could do an IRA for last year, right?
You can. Yeah. You can. And a lot of times I will prepare a tax return and I'll for friends and family, and I'll say, well, if you made this IRA contribution, it would result in this much tax savings, and they got to decide what they want to do. But other than that, there's really not a whole lot you can do. And one thing that you and I have talked about is that, I really think that people should be visiting with their CPAs before the end of the year.
Yes, thank you.
Because once you get to this point in time and you go to, people just usually go to their CPA once a year. They bring in their shoebox of receipts and tax forms they got in the mail and whatnot. But at that point in time, I mean, as you and I have discussed, I mean, a tax preparer is just really a glorified historian at that point in time. He or she is just going to try and paint the best picture they can possibly paint with what has been done. But what I find when I'm doing tax work for folks, I'll look at something and I'll say, man, if you'd only called me about this, we could have structured this a little bit differently and would have saved you some money or postponed paying a tax. I mean, you always want to postpone paying taxes off and accelerate deductions coming in, right?
Yeah. Well,
I can give you this just happened to me just this week. I was calling, talking about some things, and he and some buddies had bought a condo out in Colorado, I believe. It was in a skiing community. And it was something they bought 6 years ago, and they rented it out. And but it was always intended to be an investment property. So he calls me, and we're talking, and he says, "Oh, did you know I sold that condo?" And I said, "Oh, great." He said, "Yeah." I said, "We almost doubled our investment." He said, we put, I don't know what, he didn't tell me what it was, but I put X down and we sold it for 2X. And I said, "Well, when did that sale happen?" And he said, it was December, January, and I'm thinking to myself, say January.
Right.
But he says, no, it was December because my CPA told me I'm going to have a big capital gains tax. And I was like, well, there is an example where you should have talked to a CPA before.
Yeah.
Because it would have probably been very easy to negotiate that sale to happen in January.
Yeah.
So now the tax that's going to be due in April, it would have been due a year this April, and it would give him time to harvest any losses he has in the stock portfolio to offset that gain. Or
not that our stock portfolios ever have losses.
Right.
But theoretically.
No. But he's not with you.
Of course,
So
Let's make that clear.
So anyhow, he lost that opportunity.
Yeah, I think that is.
And those are the things where I think that people should spend, I mean, how many times do your clients come in to see you?
Several times a year.
And what are they in there for?
Planning, preparation, review.
But they're in there to mitigate their market risk.
Sure.
Protect their assets.
Yeah. And tax planning.
Maximize profits, minimize expense, all that. And for the same reasons, I would argue you should see your tax preparer several times a year too.
Well, I think that's your point is, and you and I did talk about this, and I never really, I think I knew what you were saying was true, but I never thought about it until you pointed it out to me that, typically an accountant's playing defense in April, right? They're
Absolutely.
a total defense. They've got 1,000 returns sitting in front of them. They're just trying to knock them out. And
sure, it's an assembly line.
Really doing planning at that point. I mean, the horses are so far out of that barn, you can't even see them anymore.
Right. They're just going. They call you. Okay, your tax returns. We just e-filed it.
Yeah.
The bill's in the mail.
Next.
Yeah.
And my point, and your point that you just made was excellent. In your brother's case, whether it's your brother or anybody else, had that accountant said, "Look, man, push that off to January," and that gives us the entire year to, all joking aside, to look at your stock portfolio or whatever capital gain opportunities you do or do not have and say, well, Microsoft or Apple or whatever was down. We got a $30,000 loss. We still like Microsoft, and we're going to buy it back in 31 days or whatever the number is.
Yeah.
But let's harvest that $30,000 loss to put against your $100,000 gain in the condo, and now you're only paying taxes on $70,000. So that example. So that is a perfect example of why I think clients, financial services clients, whether they're my client or CPA's client, need to be more proactive. Now, they are with me. They don't really have a choice because I drag them in a couple times a year.
Right.
But CPAs are not typically proactive. And they need to, so therefore you as the client need to say, listen, I want to meet with you in August. I want to meet with you again maybe in October, or at least have a phone conversation.
Right, they should. They should.
To be out, because these are sometimes these are $10,000, $20,000, $30,000 issues.
Yeah, they can be.
Yeah,
absolutely, they can be. Well, the difference between you and a CPA firm is CPAs bill by the drink.
Yeah,
and you're going to get paid the same amount.
I get an annual fee. Yeah, show up or don't show up.
Yeah, whether they show up or not.
Yeah,
that you get paid the same. So in people's minds are like, well, if I go see my CPA, he's going to charge me. And I'm like, well, but you don't think Scott's not getting paid? I mean,
sure.
Scott's getting paid.
Yeah.
So
Scott likes to get paid.
Yeah, Scott likes to get paid.
My wife's really in favor of it. Yeah.
So anyhow, so I wouldn't be afraid of going to see your CPA. You may have to pay them, but that's the time when they can sit down, they can focus, they can think a little bit about, okay, how do we strategize minimizing your tax rate risk? I mean, you worry about market rate risk, but
sure.
there's tax rate risk too. So how do you minimize that?
And it's penny wise and pound foolish, because if you say, well, my accountant gets whatever our accountant gets per hour, I don't know, $100 an hour, whatever the number is, and you say, well, I don't want to spend $200 or $150 having that conversation. Meanwhile, your tax bill's $10,000 too high in some cases, right? So, again, penny wise, pound foolish. Don't not spend that $100 to save $10,000. I guess is my point, and I think your point, and that won't always be the case. You won't always save $10,000. That's really not what I'm saying, but I think oftentimes that's what people think. They think, well, it's not worth it. Sometimes it is worth it.
Well, it may not be worth it that year, but you may have strategies that are multi-year or, into retirement kind of strategies that you want to follow. Well,
I also think that the idea that you would have to pay an hourly rate isn't always true either. You could, if you go into a relationship with any professional, a CPA or whoever it is, and you say, look, I would like to meet with you this many times in advance.
Right.
How much will you charge me for that, or can we build that into a retainer, or is there some kind of
Sure, I'm sure you can negotiate.
Work out a deal.
Yeah, sure, because all professionals would love to know they've got the work. It's kind of like if I got this work in the bank, they can probably do it for cheap. Be willing to do it for a cheaper price.
I think the other part of it is, and this is also true of my business, people think they know things that they don't know. Like, how hard can it be? Scott does it, which I totally understand. But in your case,
I've got TurboTax.
Yeah, that's right. But they don't know sometimes what they don't know, and I don't think you should overestimate your. I've been in the investment business for 33 years. You, on a regular basis, tell me things that I didn't think of in terms of tax preparation. That you were talking about that real. I know it's true. You're a smart guy, John. I don't care what your wife says. You're a smart guy. But you have told me many times ideas with regard to a tax return or to a client review or whatever, things to look for that I hadn't even considered. And again, I'm immersed in it every day. Right. Much like that cloth is immersed in coffee right now.
Coffee, yeah.
Which that was really good coffee, by the way.
Well, the good news was it was black coffee and it's a black tabletop, so it won't stain. So.
It'll smell good later. So again, simply put, don't underestimate the value of having a conversation proactively.
Yeah, absolutely.
And how often would you say, I mean, should they go in once every 6 months?
I would certainly go in. I would certainly want to get in there in, like, say, September, October.
Okay.
You can talk about things like, I've got a condo up for sale, and what's that going to do to me? Or, you know, what's the new tax law legislation this year, which there's been a ton of this year. So, you know, and does any of that apply to me?
Right.
Is there anything I need to be aware of? You know, okay, so for example, somebody had gone in and there's no RMDs this year. So, you know, one of the things I read and I thought was brilliant, I was like, maybe you consider taking the normal RMD that you would have taken and convert it to a Roth. And I thought, well, that's pretty darn smart, because Roths have a lot of advantages that traditional IRAs don't.
Sure.
Because, and then in the next, because Roths are not subject to RMDs.
Right.
So now you've actually lowered your base. So when you have next year's RMD, then you're going to have a less of an RMD because of that.
Yeah, and that's an interesting one. People ask about that all the time, and so you know, so I'll ask you this question, because I get asked this question quite a bit. Is if you are in your 70s and you do convert to a Roth from a traditional, obviously there's an upfront cost to that. You have to pay the taxes due immediately. So the question is the potential, say the average life expectancy is 84 or 85, let's say, at that stage of the game, is it really worth it? Like, will you pure dollars to dollars, is it worth it to make that transaction? Is there a cut and dry answer to that, do you think, or it's just it depends?
The answer is it depends, but here's the deal. You know, I always hear people say, well, when you're in your 30s, you want to be in a Roth. When you get to be 45, you switch over to a traditional.
Mm-hmm.
And I'm like, and I was always like, why do people make these statements? And actually, you know, when you put pencil to paper and actually do the math, here's the bottom line. Whether you're in a Roth or a traditional IRA, assuming that your personal tax rate doesn't change.
Yeah.
So say you're in the 25% tax rate today.
Yeah.
And you know you're going to be in the 25% tax rate in 20 years when you retire.
Sure.
Assuming that tax rate doesn't change.
Yeah.
You're going to be in exactly the same spot either way you go.
Either way.
Net of tax, you're going to if you end up with net $100,000 in an IRA, you're going to end up net $100,000 in a Roth IRA. So the only thing that makes a difference is the tax rate. It's a tax rate play.
Right.
End of day, it's a tax rate play. So if I'm in a really high tax rate today, and I think I'm going to be in a really low tax rate when I retire,
yeah,
then you want to go traditional.
Yeah.
But here's the thing: you don't know what you're going to be in.
Yeah.
When you retire.
Yeah.
And as we said before, there's a new sheriff in town.
Sure.
And I think, you know, tax rates right now are at historic lows.
Right.
I don't see them going anywhere but up.
Sure.
And I would imagine a lot of your clients, when they retire, they're probably going to retire to incomes that are actually pretty similar to what they're in now.
Yeah, if they're not exactly the same, they're going to be close. And
so they'll be in a very similar tax rate position, but if taxes go up. So my advice to somebody, and I'm not a financial guy, I don't have my Series 7 license and all that, but my advice is to hedge your bets and try to set yourself up for retirement with like 50% of your retirement assets in a Roth or non-taxable and 50% into an IRA, just because you don't know what the markets are going to be doing, you don't know what tax rates are going to be doing, and you don't know what your own personal tax rate's going to be when you retire. So if you have 50-50, then you can pull either string you want when you're in retirement.
And I like it as a planning tool, and again, this is all hypothetical, of course, but as a planning tool for a client, I also like the flexibility of a client calls up and says, you know, you call me up and you say, look, Scott, Bonnie and I have decided we're going to do that trip to Europe we've always talked about. We're going to be there for 3 months, and it's going to cost $50,000.
Right.
I like the flexibility to say, all right, well, let's go to the Roth for that, because that's not going to.
So we don't jack up your income.
You're not going to jack up your income. You're not going to get smoked. Right. You're not going to have to put 15 of it aside of the 50 you took out.
Right.
I love that planning. And the other, correct me if I'm wrong on this assumption, but my understanding is also when it comes to figuring out the taxability of Social Security, the only income you can take and not have it apply to your Social Security taxability, including municipal bonds, is a Roth. Is that? I suspect that's right. Yeah.
I'm not going to give that
I've
advice.
heard that. Yeah. Okay.
I could be wrong.
We'll get back to you on that one.
Yeah, we'll get back to you on
that.
But
that one is one that I've heard and had more than a few professionals tell me.
Well, then that's probably right.
Yeah, I think that is correct. So I think that is also a wonderful planning tool. How are we doing on time there, Ash?
27.
Wow. Man, we're chatty Cathy's, aren't we?
Another thing that's great about Roths is they're not subject to RMDs.
Yeah.
And then if you pass away and leave that to your children, it goes to them tax-free.
Yeah.
And they don't have any requirement to get it out. One of the laws I just passed was on traditional IRAs. So if you die, leave monies to your kids, they have to withdraw it within 10 years.
Yeah.
And if they're at a stage in their life where they're 45, 50, and they're like hitting their stride as far as income, well, now you're just piling on a ton of money on top of that, so you're just going to boost them into even a higher tax bracket. So a Roth is nice because it doesn't do that to them.
So as a planning tool, really what you're talking about, well, not entirely, but to some degree, if somebody's in their 30s or 40s and they're really getting serious about planning for their retirement, as a planning tool, maybe they should consider putting half their money at the very least in a Roth, half their money in traditional.
Absolutely. That's what I would recommend.
People want the immediate gratification of the deduction. I get that.
Sure.
But I think there's also a long game you're playing too. I personally do pretty much what you're describing. I put half in one and half in the other. So I think it is a thing to consider when you sit down and get serious about your planning is what does that look like? And all the good planning software now, like the ones you have seen in my office that we use, we call it goal planning and monitoring, actually takes into account the taxability of that withdrawal, which will affect your ability, your success or your chance of success based on how much taxes you have to pay, because that's a real factor.
Right. Oh, yeah.
And I don't think a lot of people consider, well, yeah, I need $100,000, but I also have to pay because of where it's coming from, because of the faucet I'm turning on.
I need $125,000.
I need $125,000. So,
well, that's like same thing. You know, if you sit down with a client and you guys together decide, well, I need like $4 million in retirement assets so I can maintain the style I want to.
I'm accustomed to.
Yeah, I'm accustomed to,
as they say.
And so then you hit that $4 million and think, great, I've arrived at the promised land. But then you look at it's all taxable.
Yeah.
So if you're in a 25% tax bracket, you're giving, well, you won't be giving a whole million to the government. You're going to probably give about $700,000 or $800,000.
Well, you're going to give of your hypothetical, say at 4%, your hypothetical income's $200,000. 50 of it's going to Uncle Sam.
Yeah. So it's. And the other thing that's nice about being able to use Roth monies in retirement is that if you're used to like let's just pick a number, $200,000. Say you're used to a $200,000 a year income. Well, if you can make 100 of that Roth, then that lowers your taxable income. And when you lower the taxable income, that's when any credits that are available are going to be hanging down around that line, because credits phase out when you get to like 100, 125, 150,000. Then those credits phase out over that. So it will make. So not only will you pay less just top line tax, it may make you available for, if they are applicable, it would make you available for more credits too.
I mean, I think it's funny, you and I have been talking for 30 minutes about numerous ideas, numerous concepts that I don't think people spend 2 seconds on in April when they're dealing with this stuff. They're
right, because right now they just got to get a tax return.
They're under the gun. They got to get this done. They're worried about filing late and all those sort of things. So 2 points I want to make in closing. One is that these are all just ideas, hypothetical ideas to think about. Somewhere in St. Pete's, a very nervous compliance officer watching all this stuff.
Yeah. He's going to walk through this back door.
And now I'm making Ashley nervous because she's going to have to deal with it. But these are all just ideas and concepts to explore with your own CPA. The other is that John is not here by accident. He didn't just accidentally wander into the studio.
Yeah, it was the free lunch.
It was. He got a free cup of coffee, and I got one too, but I no longer have it for some reason. But he's also working with our practice to help some of our clients who want to have a conversation like this one-on-one. This is my basically announcement that he's going to be available to do that for you. He's been a good friend and part of our firm's family for a while now, and I would urge anyone who has intricate tax questions to seek John's counsel to help guide them. And again, that is, I call it
just a discussion.
Just a discussion.
Yeah.
It's third base accounting, I like to call it. We're going to take you to, around the bases, but your CPA, your own tax preparer, needs to bring you all the way to home plate. But we're excited for you to be able to have these kinds of conversations one-on-one with actual clients. So any last-minute words of wisdom before I take us out of here?
No, I would I would just say there's been a lot of tax law changes, so you might want to interview your tax preparer and just make sure that they've, that they're well aware of them, and make sure, because there's a lot of new stuff in the tax law, so it could very well be stuff that may apply to you. So
yeah, I mean,
ask those questions.
Yeah, you should Google that stuff and bring that to your accountant. Professionals love when you Google stuff and bring it in.
Yeah.
All right.
I bet you do.
Yeah. Well, anyway, thank you, John, by the way.
Thank you.
And this won't be the last time I'm going to drag you in here and make you tell people stuff.
Okay.
I think it was a wonderful discussion. Ash, Vin, any tax questions while we're here? Yeah, right. All right, well, that is a wrap on ScottCast, the podcast, episode 26 with John Eicher, CPA, taxman extraordinaire.
I made it to the ScottCast.
That's right.
That's
you are
deal.
big time now, baby.
I'm big time now.
Woo! Your followers will go up to 3 or 4 on Twitter.